Why do so many investors swear by stocks as a solid long-term investment? Let's break it down. Welcome. Every day, I break down personal finance questions asked on Stack Exchange, highlight the community's best answers, and sprinkle in some actionable takeaways. If you're into learning a little more about money each day, make sure to subscribe to the channel. Now let's dig into today's question. Today we're exploring a common question. Why do stocks generally rise over the long term? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So, in summary, someone's diving into the idea that stocks are generally a good bet for long-term growth, usually ticking up around 5 to 7% each year. While this has been true for the S&P 500 over the last 100 years, other markets like those in Shanghai and Japan haven't followed the same path. They're wondering if this growth rate is just a feature of American stocks, and if the S&P 500's success is linked to the U.S. economic strength over time. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's explained that stocks earn a premium because investors take on market risk. Stock prices tend to rise when companies reinvest profits instead of paying high dividends. The market risk premium is estimated at 5 to 7%, but can fluctuate with economic changes. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. One response points out that long-term averages can still result in losses over 20-plus year periods. However, by reinvesting dividends and selling options, one can lower their cost basis, which allows for bigger profits with smaller percentage gains. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. In one response, it's noted that despite facing significant historical challenges like world wars and economic recessions, the USA has maintained an average growth rate of 7%. This suggests that the country might continue growing, even if it encounters future obstacles. Alright, now that we've seen what the community had to say, here's our take on this question. Stocks generally rise over the long term as companies grow and boost profits. By regularly investing in a diverse portfolio, you can capture these gains. Economic growth and innovation propel the stock market upward, so holding investments through ups and downs lets you benefit from that trend. Even with short-term bumps, stocks usually outperform other investments like bonds over time. So, in this video, we've covered how stocks generally rise over the long term, driven by company growth and economic innovation. By diversifying and holding on to investments, one can capture gains as stocks typically outperform bonds, offering higher potential returns. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.